Hey, Mike. Today I want to talk about when to buy the dip in a stock. That's because a lot of times when a stock pulls back, I'll sometimes say this is a good time to buy the dip. And so you may be wondering when is a good time to buy the dip in a stock because there are some parameters that you want to use. You don't always want to buy a stock that has fallen because sometimes if you buy the wrong stock that has fallen, you end up just losing money right away. And I'll show you the difference. I'll show you the parameters that I've used that it doesn't give you 100% success, but it gives you more success than failure. So you end up ahead. And also, what buying the dip when you follow this strategy, it prevents you from really getting hurt by buying the wrong type of stock, which I call well, a lot of people call catching a falling knife. So I'm going to talk about buying the dip versus catching a falling knife. So what's the difference? Buying the dip is basically buying a good stock that has fallen above key support. And I'll explain what the key support is later. Catching a falling knife is buying a bad stock that has fallen below key support. So I'll explain because it's really simple what the key support is. So what you want to do when you buy the dip here is number one, look for a stock that has fallen more than 5% in 10 or less trading days. So it has fallen 5%, which is pretty significant in less than 10 trade days. So it's a kind of a short period of time. Make sure that stock is still above the 50-day moving average. And you want to make sure the 50-day moving average is above the 200-day moving average. So this is a stock that has been performing really well, but it's just fallen 5% or more in 10 days. It's usually the most common type of buy the dip situations is that you have a stock that runs very far, very fast, like a Tesla or NEO, and it just has, maybe it went up 20% in like 1 month and then it pulls back 10%. That's a perfect buy the dip opportunity. And what you want to do is if you want to use this as a short-term trade, just exit the trade 5 days later. Now you could do this as a straight stock where you just buy the stock, or you could do an options play where you do a debit call spread, you open a debit call spread, or you sell a credit spread, a put credit spread. But if you're just starting out, you could just buy the stock because options could be a little more complex. But you just find a stock that maybe it's been running really well. It falls more than 5% in less than 10 trading days, but still above the 50-day moving average. The 50-day is still above the 200-day. And then if you want, you could just exit 5 trading days later. And it's really that simple. Now, if you want to buy the dip opportunities, just keep watching my channel because almost I would say maybe every day or every other day, I put out a video that says, oh, this stock has fallen, but it's a great stock, so it's a buy the dip opportunity. So that's what I mean. You could just go back to this video review if you're looking for stocks that qualify under a buy the dip strategy. This also works for ETFs. Let's say if the S&P has fallen 5% or more in 10 or less trading days, but still above the 50-day moving average, or the NASDAQ, or like oil or gold or anything like that. It's usually, like I said, this is not a strategy that wins 100% of the time, but you tend to win more than you lose. And that's really the basics of stock investing. It's just you're not going to win every time, but you just want to win more than you lose. So I hope this video was valuable for you. If it was, be sure to leave a like and go ahead and subscribe and turn on notifications because I will be able to show you when these buy the dip opportunities come up. I'll definitely do videos about them, and it'll just keep you better informed, gives you more good information to deal with. Okay, thanks a lot. Bye.